Muhammed Demir joins us now, head of capital markets at Swiss Finance Corporation, to mark this moment. Muhammed, 15 years on, you were trading the markets when Lehman collapsed back in 2008. I'm curious, when you look back at 2023 and the turmoil we've seen in the banking sector, starting with the U.S. and then moving over to Switzerland, whether you think this period was reminiscent in any way of what we saw back then.
Well, things have changed and it hasn't changed in a way. When we look at the different troubles in the market, with the Credit Suisse, for example, it's quite the same story. So it doesn't look like we have learned our lesson over there. It's always the risk and return in the markets, and banks will always want to take more risk to earn more money, to execute more trades. Whereas when it comes to the banking sector, small banks, it's a different story. The reason is different, but the impact is the same. So it looks like the regulators are either not applying the stress test properly, or the stress tests that we apply are not good enough to regulate the banking sector anymore.
Muhammed, I'm a little bit surprised to hear you liken the Credit Suisse collapse to what we saw back in 2008, because yes, you can obviously say that the bank did collapse. It did end up in the arms of UBS, but it was pretty contained and the market was really resilient. It moved past it very, very quickly. So where do the parallels stop?
If you look at both cases, two big banks back in the day, 2008, Lehman Brothers, and now Credit Suisse, they are very major investment banks globally. That means that they have a lot of positions with other counterparties, with other major investment banks. So the counterparty risk comes into play here. And because they were about to fail their obligations and as a counterparty, it would have a knock-on effect with the other investment banks and the whole financial system. And in both cases, in the first one, the government bailed out the big bank so that there is no contagion in the financial markets. In the second one, another bank just bought the Credit Suisse. UBS bought Credit Suisse with the push of the government and the regulatory body over there. So in terms of who bought and who saved the market, who saved the contagion, contained the contagion effect, it's different. But in terms of the cause and effect relationship, it's almost the same. And if you look at the OTC derivatives market, it's more than 600 trillion market. So it's almost like 20 times the GDP of US. And if anything goes bad over there, which includes all the major banks, then you have a trouble globally.
Well, Muhammad, you paint quite a dismal picture, but if you look at things like capital ratios, liquidity requirements, those have gone up a lot in the last decade. And I remember, back in March, April, when we were discussing the potential contagion out of US regional banks, what was happening with Credit Suisse, UBS to the broader banking market. Back then we were saying, well, the European banking system and US, the larger banks, are actually in a very strong capital position. They've got healthy CET1 ratios, they've got good liquidity ratios, and they were therefore in a position to potentially suffer some losses on their balance sheet. And many people say that that is the reason why the system held up, because actually the regulation did do its job. The banks were better equipped to deal with the shocks. What do you say to that?
If you look at the latest problem with the regional banks, the current capital ratio requirements are good enough if everything is going well, if there's no tail impact, like tail event over there. And generally the tail events, the extreme events, comes up when the economy is in a changing phase. For example, in the case of Silicon Valley Bank, the reason was not that the bank had a problem with the counterparties. They didn't apply or they didn't expect that interest rates could go up this quickly. So they invested in quite a lot of treasuries, which had huge interest rate change impact on them. So yes, if you just think that everything is going to be fine and we are going to do business as usual, you won't have any issues. But if you have any extreme moves in the market in terms of interest rate or volatility or any other input for any pricing, then you would end up with situations like Silicon Valley Bank or First Republic. And when we compare it to the 2008 crisis, the the crisis is contained just because, again, the government or the regulator just pushed other banks to contain it, and they bailed out the deposits of the investors, deposits of the customers. If they haven't done that, we would have a very different picture right now.
Muhammed, thank you for sharing your views with us. Really interesting to put into context what we've seen in the banking sector recently and to what happened 15 years ago. Muhammed Demir, head of capital markets at Swiss Finance Corporation.